Something unusual is happening at the very top of the financial food chain. The ultra-wealthy are not celebrating. They are not taking victory laps. They are not acting like the bull market will last forever. They are preparing, strategically, methodically. And whenever the people with the most information and the most money begin to prepare for impact, the rest of us should at least pay attention. Because history leaves clues. In 2007, before the global financial crisis exploded, the smartest capital in the room started shifting. Insiders sold shares. Liquidity was hoarded. Risk was reduced. And then the system cracked. Today, the signals feel familiar. This is not fear-mongering. This is pattern recognition. The super rich are positioning themselves for what could become the next major financial disruption. And they are doing it in ways that reveal 3 powerful clues about what may be coming. If you understand these 3 clues, you will not only see what they see, but you may also protect yourself from what most people will only recognize too late. Let's start with the first clue. Liquidity is king again. When money feels safe, it spreads out. It chases risk. It hunts for yield. It buys startups, art, luxury condos, tech stocks trading at impossible valuations. But when danger is sensed, everything changes. Cash becomes oxygen. Over the past 2 years, family offices and billion-dollar funds have been increasing cash positions. Private equity firms are sitting on record dry powder. Wealth managers for ultra-high net worth clients are shifting allocations toward short-term treasuries and liquid assets. That is not random. The wealthy do not hold cash because they are timid. They hold cash because they expect volatility. Cash is not just safety. Cash is optionality. When markets crash, assets go on sale. Businesses go bankrupt. Real estate becomes distressed. Liquidity allows the wealthy to buy when everyone else is forced to sell. Remember, 2008, the average investor panicked. Portfolios were destroyed. Homes were foreclosed. Retirement accounts were cut in half. Meanwhile, those with liquidity acquired prime real estate at discounts. They bought companies at cents on the dollar. They positioned themselves for the next decade of growth. Crises are not equalizers. They are accelerators. The rich who prepare become richer. And right now, preparation is happening again. Look at corporate insiders. Selling activity has consistently outpaced buying. Executives know their companies better than anyone. When they sell aggressively while publicly expressing optimism, that contrast matters. Look at the bond market. Yield curve inversions have historically preceded recessions, and we have seen one of the deepest inversions in decades. Look at private capital flows. There is a noticeable shift toward defensive sectors. Energy infrastructure, healthcare essentials, food production, hard assets. These are not the moves of people expecting endless expansion. They are the moves of people anticipating contraction. But liquidity alone does not tell the full story. The second clue is even more revealing. The super rich are diversifying outside the traditional financial system. When confidence in monetary stability declines, behavior shifts. Gold purchases by central banks have surged. That is not speculation. That is documented. Countries are increasing reserves at a pace not seen in decades. Why would they do that? Because gold is nobody's liability. It does not depend on a government's promise. It does not rely on a bank's solvency. It is insurance against systemic risk. Now, look at private wealth. High net worth individuals are allocating more capital into tangible assets, water rights, energy projects, physical commodities. This is strategic insulation. If inflation spikes again, tangible assets hold value better than paper promises. And inflation is not gone. It may have cooled from its peak, but structural forces remain. Massive government debt, ongoing deficit spending, geopolitical fragmentation, supply chain realignments. These forces are inflationary by nature. The wealthy understand that currency risk is real. They understand that governments facing debt pressure often choose the politically easier path of inflation over austerity. Printing money is invisible taxation, and the people who feel it most are those holding cash without assets. That is why diversification into real assets is increasing. But there is something even more subtle happening. Capital is flowing into private markets at unprecedented levels. Private credit funds are booming. Direct lending is replacing traditional banks. Private equity is consolidating industries quietly. Why does that matter? Because when stress hits the public markets, private capital becomes the stabilizer and the acquirer. Banks are already more cautious. Regional banking turmoil has exposed fragility. Stricter lending standards are quietly tightening credit conditions. Credit is the bloodstream of the economy. When it constricts, growth slows, businesses struggle, unemployment rises, consumer spending weakens. The wealthy are positioning themselves on the lending side of the equation. In times of stress, lenders gain leverage. Interest rates remain elevated compared to the ultra-low era of the 2000s. Debt servicing costs are climbing for corporations and governments alike. This is not a minor detail. Global debt levels are at historic highs. Higher rates make that debt heavier. Refinancing becomes painful. Defaults increase. And when defaults increase, assets change hands. The super rich are preparing to be the ones receiving those assets. Now, let's talk about the third clue. Geographic diversification. Capital is mobile. The wealthy are more global than ever. Residency by investment programs are seeing renewed interest. Multiple passports are becoming a strategic tool, not a luxury status symbol, because political risk is rising. Tax policy uncertainty is growing. Regulatory environments are shifting quickly. Geopolitical tensions are reshaping alliances. When instability increases, mobility becomes insurance. Family offices are spreading capital across jurisdictions. Real estate acquisitions are no longer concentrated in one country. Banking relationships are diversified internationally. This is not paranoia. It is risk management at scale. History shows that major financial crises rarely stay contained. They ripple across borders. They expose weak links in global systems. The wealthy do not assume their home country is immune. They plan for systemic stress. Now, let's zoom out. Why would a major crisis even be possible right now? On the surface, markets look resilient. Stock indices hover near highs. Unemployment rates remain relatively low. Corporate earnings, while slowing, have not collapsed. So where is the danger? The danger lies beneath the surface. Consumer savings built during stimulus years are declining. Credit card balances are at record highs. Auto loan delinquencies are creeping upward. Commercial real estate faces structural shifts due to remote work. Office vacancies remain elevated in major cities. Property valuations are under pressure. Small businesses are squeezed between rising costs and cautious consumers. Meanwhile, government debt continues expanding. Servicing that debt consumes a growing portion of budgets. At some point, trade-offs become unavoidable. Raise taxes, cut spending, print money, or face market backlash. None of those options are painless, and markets eventually force discipline. Think about the psychology of cycles. During long expansions, risk feels normal. Leverage feels manageable. Optimism feels rational. Then something breaks. Sometimes it is a bank. Sometimes it is a housing bubble. Sometimes it is a sovereign debt crisis. The trigger is rarely obvious in advance, but the conditions build slowly. Today, leverage is high. Asset valuations remain elevated in key sectors. Geopolitical tensions add uncertainty. The wealthy are not predicting the exact spark. They are preparing for the inevitability of a correction. And corrections are not gentle when imbalances are large. Here is a powerful insight. The super rich do not try to time the exact day of collapse. They build resilience before it happens. They reduce exposure to the most fragile parts of the system. They increase flexibility. They hold assets that can survive inflation or deflation. They diversify politically and geographically. They accept lower short-term returns in exchange for long-term security. That mindset is instructive Because most retail investors do the opposite. They chase performance late in the cycle. They increase risk when optimism peaks. They assume recent trends will continue. That is human nature. But cycles do not care about human nature. They follow mathematics and incentives. Debt cannot outgrow income forever. Asset prices cannot detach from fundamentals indefinitely. Confidence cannot remain high when cracks appear. And cracks are appearing. Look at global trade fragmentation. Look at rising protectionism. Look at supply chains being reconfigured for political reasons rather than efficiency. That adds cost. Look at demographic shifts in developed nations. Aging populations strain pension systems and healthcare budgets. That adds fiscal pressure. Look at technological disruption. Artificial intelligence is transforming industries rapidly. That creates both opportunity and displacement. Periods of rapid transition often coincide with financial instability. Now, here is the pattern interrupt. This does not mean the world is ending. It means volatility is likely increasing. There is a difference. The wealthy thrive in volatility if they are prepared. They suffer when they are overexposed. Right now, their behavior suggests preparation. Record levels of hedging strategies are being used by institutional players. Options markets show increased demand for downside protection. Hedge funds are running more market-neutral strategies. That is not the posture of blind optimism. It is the posture of calculated caution. And here is something subtle but critical. Philanthropic foundations tied to billionaire families are adjusting payout strategies. Because even charitable capital anticipates changing return environments. When endowments expect lower returns, they plan conservatively. That is forward-looking. Even luxury markets tell a story. Ultra-luxury real estate transactions are happening, but with more negotiation and selectivity. High-end art markets have cooled from frenzy levels. Speculative enthusiasm has tempered. Excess is often the peak signal of a cycle. Restraint often signals transition. Now let's connect the three clues clearly. First, liquidity accumulation. Second, diversification into tangible and private assets. Third, geographic and political risk hedging. Together, they paint a picture. The super rich are not betting on smooth sailing. They are preparing for turbulence. So what can an ordinary person take from this? You do not need $1 billion to think strategically. You need awareness. Ask yourself simple questions. How exposed are you to one income source? How exposed are you to one asset class? How resilient is your financial structure if credit tightens? Do you have liquidity if opportunity appears? Are you positioned only for growth or also for protection? This is not about panic. It is about preparation. Financial crises are brutal for the unprepared, but they are transformative for the prepared. Every major downturn has created new millionaires and billionaires, not because they predicted the exact moment, but because they structured their lives to survive and capitalize. The 2000 dot-com crash wiped out paper fortunes. It also birthed disciplined tech investors who built empires afterward. The 2008 crisis destroyed leveraged speculators. It rewarded those who bought quality assets when fear was highest. The pandemic crash in 2020 was violent and fast. Those with liquidity who stepped in during peak fear saw extraordinary returns. Patterns repeat, human behavior repeats. Overconfidence builds, excess accumulates. Stress fractures form. Then reality reasserts itself. The wealthy are not immune to mistakes, but they tend to move earlier. They have access to better data. They have direct conversations with policymakers. They see credit conditions firsthand, and right now, their collective posture is defensive. That does not guarantee immediate collapse, but it does increase the probability of significant volatility ahead. So here's the real warning. Do not be lulled by surface calm. Do not assume record highs mean record safety. Do not mistake temporary resilience for structural strength. Watch what capital does, not what headlines say. Capital is quietly bracing, and when the most sophisticated money in the world begins to brace, it is rarely random. The question is not whether cycles will continue. They always do. The question is where you will stand when the next major shift unfolds. Will you be overleveraged and reactive? Or will you be liquid and strategic? Will you be concentrated and fragile? Or diversified and resilient? The super rich are making their choice. They are choosing flexibility. They are choosing hard assets. They are choosing global mobility. They are choosing caution over complacency. That is the signal, not hysteria, preparation. And preparation is powerful, because when the next crisis hits, and it will eventually, those who prepared will not just survive, they will advance, and that may be the most important lesson of all.